Hello traders, welcome to the webinar. This is Terrence Hooi and welcome. So on today's webinar, I will be touching base on a few more advanced concepts. And on this webinar, we'll be talking about how to structure a butterfly spread, which is going to be a little bit more advanced. But in a way, in markets like this, I would like to use a few examples to show you why, in a very sideways or consolidating markets, butterfly spreads will be one of the best strategies you can use to increase the risk and reward for your trading. And also I'll be sharing my screen with you on how to structure, butterfly spreads using alley wave analysis, right? And, a slightly more advanced module which will be tiering entry and exits. How we as traders, so in this concept, how we as traders can increase the probability of success and at the same time keeping the risk low. So again, I'm very happy to have all of you in this webinar, and I will be taking any of your questions. All you have to do is type in your questions in the chat box, and I'll try my best to answer any of your questions in the chat box function on the right hand side, right? And if I miss any of your questions, you can always drop me an email at terrence@livetrader.com. So there are two ways to communicate with me. One will be through the chat function on your right hand side, and the other one will be just dropping an email. You can ask me any questions before and after the webinar. If you're watching this as a replay, you can also drop me any questions. You can always drop me an email with any of your questions, right? So just so that I do not leave any questions unanswered, right? So let's dive into the webinar. So I will be sharing the first technique on how to plot basic alley waves, right? So what is an alley wave? I spent some time to explain what is an alley wave because some of you probably is very new for you, and I'll explain why we use this this strategy called alley wave analysis, and how you can gain an unfair advantage when it comes to trading using alley waves, right? So alley waves will be the Dow theory, all right? And the Dow theory, which I'll be showing you using a few case studies, all right? The Dow theory actually predicted the 2008 financial crash. And, by using the Dow theory, we are actually plotting to see if, the market is topping out in 2017, where we are right now, right? So in this technique, I'll be showing you how to plot alley waves plus fib retracements. All right. Now, before I dive into the case study, I'll be explaining what is an alley wave and what is a Fibonacci retrace or Fibonacci analysis. Right. So actually, there are two vital components to increasing your entry and exits accuracy, and one is that we use alley wave analysis to potentially increase your risk and reward per trade. And what do I mean by that? Alright, so let me just explain what is an alley wave and why do we use the wave principle. Alright, so the alley wave principle is a form of technical analysis that traders use to analyze financial market cycles and forecast market trends by identifying extremes in investors' psychology, highs and lows in prices, and other collective factors. Right, so there are two types of indicators. The first one will be a lagging indicator, which gives a signal after the new trend or reversal has happened. And most of the indicators out there, I would say 90% of the indicators out there are lagging indicators. Indicators like stochastics, MACD, CCI, right? All those are lagging indicators, right? So to gain an unfair advantage when it comes to trading, we are focusing mainly on leading indicators. Right, so what are leading indicators? Leading indicators gives a signal before a new trend or reversal happens. Right, these types of indicators signal future events. So in the world of finance, leading indicators work the same way. right? So, for instance, bond yields are thought to be a good leading indicator of the stock market because bond traders anticipate and speculate trends in the economy, even though they are not always right. Okay, so, all right, so who invented the Elliott wave? Ralph Nelson Elliott, all right, he invented the Elliott wave concept by using crowd behavior, trends and reversals in recognizable patterns or waves. So these structures link together to form larger versions of the same patterns and how those become the building blocks for patterns of the next larger size and so on. Elliott also coined the wave principle. All right, so I'll be using a lot of examples in this webinar to show you how you can identify the wave structure. All right, so in any markets, I believe all the markets are emotional, and by using Elliott wave analysis, it kind of deciphers the crowd behavior and gives you a context of whether or not the market is in a trend or the market is in this non-directional consolidating pattern. Right, so it follows the pattern like this. Impulsive, we'll be having 5 waves to the upside, followed by a corrective wave of an ABC. Right, so you will probably get waves within waves. Right, if we break down from let's say 0 to 1, you find a smaller impulsive 5 waves to the upside. And if we break down from 1 to 2, there's an ABC corrective wave. And then from 2 to 3 in blue, you can see another small impulsive 5 waves to the upside, right? So you can actually use this pattern and try plotting on, let's say, the S&P 500 or the NASDAQ. You can see the pattern repeating over and over again, right? And why do we use this? Because, it's a very good analysis. It gives you a very good context of where the market is, so we can adjust the risk and reward accordingly, right, to put the odds in our favor, right? Now, we use Elliott wave and fib retracement exclusively, and I teach you in this webinar how to combine these two strategies, these two techniques to give you to increase your success in trading. Right, so we use a lot of degrees when it comes to Elliott waves. On a higher degree, let's say on a weekly chart, on a daily chart, on a 4-hour chart, on a 1-hour chart, we use different symbols. All right, so you can see a lot of those in your traders report, different symbols. That means that with every time frame, we're using either Roman characters or just numericals to identify whether this will be on a higher time frame or lower time frame, right? The most frequent symbols that you see on, let's say, the traders report or the video update will be, numbers in brackets or in Roman characters, and that will be on a smaller degree, right? So I'm going to explain how impulsive waves work, right? So there are 2 types of impulse wave, right? The first one being extension and the next one being a truncation, all right? And for an extension, the pattern will be like this, right? You will find a 5 impulsive wave higher. In this case, let's use Dow Jones Industrial Average. A 5 wave to the upside in circle will be the higher degree, like I mentioned earlier, right? So we use different degrees. So let's say on a higher degree, let's assume a more heavyweight time frame. Let's say in this case a yearly chart, right? So on a higher degree, we use a circle 1, 2, 3, 4, 5, and on a smaller degree, it could be a weekly chart. We will be using another 1, 2, 3, 4, 5, but in bracket, all right? So like I mentioned earlier, if we break down from 4 to 5, right, expect an impulsive 5 waves to the upside. And if we break down from, let's say, 1 to 2, you expect an ABC corrective wave lower, right? So impulse truncation will go like this, where the 5th wave fails to break the low of wave 3. And bull market truncation is that the 5th wave fails to breach the high of 3rd wave, right? Now, triangles are one of my favorite patterns because triangles, it says that a consolidation is ending and a possible breakout is developing, all right? So if you happen to capture any breakouts, that could be potentially yielding you a very high risk and reward. All right, so corrective waves goes like this. There are two types of corrective wave. One will be zigzag pattern, where the C wave will be lower than the wave A, and a flat pattern, which will be more common in this consolidating markets. So a flat pattern, it shows that the C wave is not lower than wave A. All right, and let's move on to triangle patterns. This will be my favorite because you know, most of the time from 3 to 4, right, wave 3 to wave 4, you can find a triangle pattern like this. All right, so let's assume from 3 to 4, if we break down from wave 3 to wave 4, all right, you see an ABCD pattern, and if we break out of this consolidation pattern, right, it's possibly a very big move from wave 4 to wave 5. Right, I'll be using a few more examples in the case studies to show you how triangle patterns work. So bottom line is economic reasoning will be no value in cases of uncertainty. Okay, most investors invest in the top and selling in the bottom, and you know, right, and I would say the markets, you know, stock prices move like sheeps. All right, this is what we call herding. And prices ebb and flow according to investors' optimism and pessimism. Investors use news to rationalize emotional decisions. This is where most of the people lose money, right? People respond to the news, in fact, too much, right? Now, if you check the recent news, like the geopolitical news in North Korea and you know, the Trump administration. All right, so let me ask you a question. How many times you overreacted to those news, right? You know, bottom line is do not let news to, don't rationalize, right? By reading those news, getting emotional, and not getting a context of the markets, all right? In fact, I rarely read the news, all right? It's impossible to stay up all night, you know, reading the news, catching what's happening next. And I always believe that for every trade, there's a risk, there's a reward. You know, once I define my risk, right, I just let the upside take care of itself, right? Even if there's a black swan event, right, most of the time, you know, most of the trades that we have limited downside risks. That's why we use a lot of that's why we use strategies like vertical spreads or butterfly spread, right? And this is how herding behavior results in loss. Most of the time, traders get emotional. I'd say, you know, when people are emotional, you know, we actually activate the reptilian brain. It's what we call, this is what researchers call the reptilian brain, where, you know, your emotions will cloud your judgment and you might not be trading according to the plan, right? So in any wave, emotional valuation are governed by the wave principle, all right? The reason why we're plotting the 1, 2, 3, 4, 5 and these patterns happen over and over again is because this is, you know, the markets are emotional, and in most of the time, right? And in most cases, if you see the markets moving this 1, 2, 3, 4, 5 pattern, right? If you start to break down from wave 2 to wave 3, right, you see the same pattern happening over and over again, right? And you know, we as investors or traders, we can always take advantage of this pattern, right? So those will be the rules for the wave principle. Wave 2 always retraces less than 100% of wave 1, and wave 3 is never shortest. So normally from wave 2 to wave 3 will be longest, in fact, and wave 4 does not overlap the price territory of wave 1, right? If we go into the territory of wave 1, this wave count will be invalidated. Now this example will be a bearish example, right? The predominant trend will be bearish, and for that reason you see that the 1, 2, 3, 4, 5 is pointing to the downside, right? What about bullish pattern, right? If we combine any wave and channels, which you know, gives us a context of where's the next resistance level, right? Perhaps that resistance will be your upside target or take profit level. So by using a wave in this case will be, in this example, will be 1, 2, 3, 4, 5, and then by drawing a channel trend line, all right, that will show you what is the upside target for, let's say, wave 5, right? So waves within waves anticipate large and small shifts in mass psychology which drive markets, all right? So this is how you can separate yourself from the herd. Right? Have yourself minimize the emotions that drive your investment decisions. So let me just tell you a quick story. I have a friend, he's a professional poker player. He plays poker all around the world. And, you know, for him, I always ask him that what is, you know, is playing poker risky, or can you lose all of your money, right? Now this guy, I've been watching his progress for about four years, and it seems that over the course of 4 years, he's been consistently making money, right? So I asked him, what is your secret to making, you know, this consistent profit, right? And he just tells me that it's by reading people, and it's extremely good reading people and the psychology of other players, right? In trading is no different. You have to understand the psychology of the markets, right? What is the reason why, you know, the markets ebbs and flows in such a way, right? In this pattern, right? Why are we in this all-time highs in the S&P 500, in the Nasdaq, right? And you know, last year we talked about the S&P 500 you know, hitting wave 4. We had a big drop last year, and then the market went into all-time high. That was wave 4. So let me just explain the psychology behind every wave, right? So from the bottom, right, which will be 0, right? So at the bottom, there'll be a lot of question of existence, survival. Let's say there's a depression or war, right? Let's say, you know, nearest recession I can think of will be 2008, which I'll be giving you a case study on how we plot other waves on a crash in 2008. All right, so from wave 0 to wave 1, all right, wave 1, so investors will be thinking at wave 1, right, maybe this will be a new trend, right? And then there's a pullback in wave 2, right? Those people invested in bottom are a little bit uncertain. They just sell off their investment. And wave 2 will be test of lows, which fundamental conditions often as bad as or worse than those at previous bottom. Underlying trend considered down does not carry the new low, right? So it holds over there at wave 2, and then with a rebound in the wave 3, this will be the most powerful wave, right? From wave 2 to wave 3. Another wave will be the longest wave, right? This is where most of the money is made, from wave 2 to wave 3, right? And you know, in this wave 2 to wave 3, you get a lot of the fundamentals will be the best, increasing real prosperity. Everyone is making money, and by the end of underlying trend is considered up. Wave often subdivides. And it's never shortest wave, right? So wave 2 to wave 3 will be longest, and then we expect pullback in the wave 4, which you know, those investors that invest when right in the wave 2 low will be taking some profits, right? So market pulls back, and there's a surprising disappointment. Signals the best part of growth phase has ended, right? Does not enter price territory of wave 1. As long as we do not enter the territory of wave 1, the bullish wave count from wave 4 to wave 5 is still valid, right? So this is where a lot of our short sellers will get trapped. They thought the markets would just you know, drop lower, and in fact rebounded from wave 4 to wave 5, and wave 5 will be the final wave higher, or the terminal push higher into you know, the new highs, right? So market performance and fundamentals improve, but not to levels of wave 3. Psychology creates overvaluation. So at wave 5, it's a little bit dangerous to buy stocks at this level, because you know, we could have a pullback, you know, marking an end of this overall trend. So let me just explain the psychology behind corrective waves, right? So after wave 5, prosperity and peace appear guaranteed forever. And then all of a sudden, there's a technical breakdown, right? So, at all of, you know, amateurs will be thinking that, you know, this pullback in the wave A will be a good buying opportunity. And in fact, they bought at the lows of wave A, right? Start to see some profit, some paper profit when the market rebounds in the wave B, but the markets are technically weak. Selective results in non-confirmations and fundamentals weaken subtly, and this is where most of the investors get trapped, right? With this rebound in the wave B, if you do not sell off your investments, the markets could be dropping into wave C, which will be a worse of bear market. Right, so let me just touch base on Fibonacci retracements. So two ratios that we're watching will be 61.8 or 161.8. Right, 161.8. All right, this pattern can be found anywhere. Right, this 61.8 seashells, even structures. And Einstein did mention a little bit about the golden ratio. Right, so Fib ratios, when it comes to trading, it just tells us how far, right? How much longer until we're there, right? So by combining edit wave and Fib retracements, it gives you a context of how far from, let's say, point A to point B. So there are two types of Fibonacci relationships: retracements and extensions, right? So in this case, this will be a retracement, which will be under 100%. And this will be an extension, which, so beyond wave 3, that will be extension, right? That's how we get the 161.8% retracement to get how far, you know, wave 4 can travel to wave 5. So let me just summarize everything. The wave principle states that markets are patterned. And these patterns are similar to at all time scales, right? Be it a weekly chart, a daily chart, 4 hours chart, 1 hour chart. The basic pattern consists of motif waves. 5 wave structures move in the direction of the main trend of a larger degree, followed by corrective waves, 3 wave structures that interrupt the main trend. And wave patterns adhere to certain rules, guidelines, and Fibonacci relationships. Right, so let me just dive in and give you a few case studies. All right, traders, so I'm going to show you a few, you know, patterns, classical patterns of technical analysis. You know, some of you, so my guess is some of you already know, you know, basic pattern like a triangle pattern, head and shoulders, parallel channel, bull flag, rising wedge, broadening pattern, or double bottom, right? So when we apply any wave into those classical patterns, right, we get, you know, a much clearer picture where the market is heading. You know, the most typical pattern for a wave 5 top will be an ABC decline, and, you know, with 5 wave impulsive, it gives you a much clearer context of where the market is heading. So when it comes to consolidating markets, we expect, you know, either a zigzag pattern or a flat pattern, which I'll explain later in my slides. All right, so again, if we apply, so you might have read those technical patterns, and, you know, if we apply a wave, it gives you a much, you know, clearer context of where the market is heading, right? And let's dive into a zigzag pattern. So a zigzag pattern is, you know, where we can find an ABC pattern with a 3-wave ABC structure, right? So when we break an ABC corrective, a corrective ABC zigzag pattern, we can find first an impulsive 5 waves to the downside, followed by an ABC corrective wave higher from larger degree wave A to wave B in blue, and then followed by an impulsive 5 waves to the downside. Now please note, you know, only for zigzag patterns you can find an impulsive 5 waves to the downside from wave B to wave C, right? So what do I mean by that? So wave B have to retrace less than 78.6% of wave A, and the end of wave C is lower than the start of wave A, right? So typically you find, again, a 5 impulsive wave from wave B to wave C, and that gives you a very good signal, a very good buying signal. All right, so again, if you break down from wave A to wave B, there's a corrective wave higher, ABC, and if we break down from wave B to wave C, there's an impulsive 5 waves to the downside. right? Hope it makes sense, right? Let me just give you an example of natural gas, right? So, as you can see, there's an ABC decline, and if I break down from A to B, you can see an ABC in blue, in light blue, right? And then if we break down from B to C, there's an impulsive sideways to the downside with the support level is 6.5, right? So this will be acting as a good buying level, right? Once we complete this ABC pattern, right? So a live trading example on NVIDIA, from wave 1 to wave 2, you can see a zigzag pattern. So there's a clear zigzag pattern from 1 to 2 and from B to C. If you zoom down to a smaller time frame, you should find an impulsive sideways to the downside forming wave C, right? So that's where we enter, right? Again, trading vertical spreads or trading directional, using directional strategies, timing is everything, right? So my guess is if you were to enter at wave A, right? Let's say a long position, you see some profits in the wave B, but most of profits will evaporate when the market drops in the wave C. That's where people start to panic out of the position or select an expiration that's too short, right? And probably the trade will just expire out of the money before you see a rebound from larger degree wave 2 to wave 3. Right, so again, this is very important as an early wave trader using options. Expiration, the two elements that you should pay attention to. One will be expiration, and another one will be understanding, when to enter with this corrective zigzag pattern. All right, so when it comes to corrective patterns, we could either find a zigzag pattern or triangle pattern. Right, so the triangle pattern look like this. If we break down from wave 3 to wave 4, right, expect an ABCDE pattern instead of an ABC, right? So let's take an example on Tesla. This was the trade that we established a butterfly spread. So when it comes to consolidating markets like this, so when it comes to corrective waves, right? So trades that we'll be establishing will be income trades like a butterfly spread, or maybe an iron condor, right? So example would be Tesla, right? Let's assume from 3 to 4 we establish an income trade. If the market drops sideways like this, right? So if we break down from 3 to 4, right, expect an ABCD pattern, that is a triangle pattern. And if I break down from wave A to wave B, right, if we can find more than an ABC corrective wave, that's going to be a triangle pattern, right? For triangle patterns, income strategies will be butterfly spreads or iron condors, right? My favorite will be butterfly spreads because the risk and reward will be higher than iron condor, right? And typically when in a very sideways choppy markets, you expect the IV rank or an implied volatility to be very low. So it doesn't make sense to sell iron condors because you'll be paying a lot in commissions because it's going to be a four-legged strategy. Instead, we like to establish butterfly spread because in some cases, if we can get about 1 to 2 risk and reward and above in a sideways consolidating markets, or with this pattern that I'm talking about, this triangle pattern, right, it will be a good trade, right? Let's move on to wave 2 corrections. So again, if I break down from, let's say, 1 to 2 in green, right, you should see an ABC structure, and by using Fibonacci retracement, right? Let's assume we are drawing a retracement from 0 to 1 in green, right? From 100% to 0%. Now wave 2 retraces from the 50% retracement right up to the 78.6, right? Forming wave 2. Okay, so by using Fibonacci retracements, I can set a stop loss right at the 78.6, right, to minimize my risk, to capitalize, if the market rebounds from wave 2, let's say at the 61.8% retracement, I'll have a very tight stop loss at the 78.6, and we could have a very favorable risk and reward if the market starts rebounding, trending from wave 2 to wave 3, right? So what do I mean by that? Let me just explain. In a flat correction like this, right, let's assume, right, wave C rebounds near to wave A, all right? So if I break down from B to C, there's an impulsive wave. If I break down from A to B, it's a corrective wave higher. And with this, let me pull up an example on gold, right? So wave 2, it fails to breach the low of wave C. In this case, right, it's going to be a flat pattern, right? So with flat patterns, we can start buying at the wave 2 turning level. Again, you can use fib retracements. Wave 2 will be typically at about 61.8 right down to the 78.6, acting as support for wave 2. And with that, it could give you a very favorable risk and reward, because if you look at the movement from wave 2 to wave 3, a very favorable risk and reward, be it if you're trading futures, if you're trading stocks, or if you're just using options to trade from wave 2 to wave 3. You should identify whether or not the market is in a flat correction or an ABC zigzag pattern, right, where you can use this as a gauge, right, to measure the risk and reward for your trades. All right, so again, let me just give you an example on Visa. So this is an impulsive wave, and in some cases the markets will be forming a diagonal pattern, right, where the wave 4 will overlap, going to the zone of wave 1, right? Now the typically impulsive wave 5 wave will look like this on the left, right? So it says that wave 2 to wave 3 will be longest. Visa, right? If wave 4 falls into the zone of wave 1, right, we call this a diagonal pattern, right? So again, by using Elliott wave and Fibonacci, we have an expected starting and stopping point of a trend and corrective wave, right? So you can rest easy trade with higher EQ, control your caveman tendencies, and embrace, you cannot really know the future, but you have a context of the risk and reward per trade. And with that, you have the confidence placing a trade well with a well executed trading plan. So I always believe that anticipation is power. Now there's one more thing with the markets. So just a heads up, the Dow Jones Industrial Average is at its lowest since the 1987 crash, right? So in 1987, so in 07, the subprime crash, from June to October, APTR, which is the average percent true range, started increasing before the crash happens. When it starts increasing, this is a sign that a crash is happening, right? Let's look at where we are right now, right? So in 1914, the percentage was 4.69. We started picking up. We had a depression in 1929, and in 54, the percent is at 4.59 when the range starts increasing, right? We had a crash in 1954, and in 1965 the percentage was 4.64, right? Now guess where we are right now? We are at 4.52%. It means that if this starts increasing, right, look at where the market, how far we've come, right? If the APTR starts increasing, this is a sign that we could be, hitting in the biggest crash in history, right? So let's take an example, August 28 to September 29, right? The APTR starts increasing. Now you can populate the APTR under a Thinkorswim platform. Just look for this indicator, and you can start to see from August to September, APTR is starting to creep higher, all right? And after it's reached a certain level, a crash happened. This was not too long ago. This was August 28 and 29 last year, all right? And where we are right now, the S&P 500 weekly chart, if you check, wave 5 is at about 3,000 mark, right? The resistance will be at 3,000, okay? So, since the 1987 crash until 2017, it's been 30 years since the crash in 87, and we are at record levels for the S&P 500. So right now, once the APTR starts increasing, right, I'll be staying cautious. If I have any long position, stock position in the markets, I'll be starting to sell my position. I'll be starting to gather resources to establish maybe a short position when the 3,000 mark is reached. And you'll never know. Once APTR starts increasing, the crash could happen anytime, right? So just a heads up, just to remind you that this rally cannot just go on forever. All right, it's going to be a pullback, and again, the key is to anticipate, not to react when the market crashes. All right? So again, I'm not inducing fear. I'm just saying that you should be prepared if a market is crashing. For us traders, you can make money when the market goes up, sideways, or even crashes. But most of the time when the market crashes, the market starts panicking, right? I'm sure there'll be guys out there that'll be prepared to make tons of money when the market crashes. All right. So again, a corrective wave pattern will be either a zigzag pattern, a triangle pattern, a flat pattern, or a combination. On how to plot basic alley wave structure. Right, so I'm going to be using a few case studies like the S&P 500, the SPX. Right, so let's switch over to the video lesson right now. S&P 500. Now, on today's video update, we'll be doing a very detailed analysis on the S&P 500 and where is the overall trend for the S&P 500, because for the past few days and few weeks, the S&P has been very choppy, and because of the Trump political issues, we've been rocking up and down, but if you look at historical volatility, not go away. It is just that how much a market will go, right? So now if we check the S&P 500 on a weekly chart, so this was the 09 credit crisis. So to plot alley wave, where should we start? So the first thing in alley wave theory is that you will have to look for an important low. In this case, the credit crisis low, right, will act as 0, right? And then we start plotting the first wave, second wave, right, third wave, fourth wave, and now we are tracking this move high into the fifth wave. Now, it is also very important to recognize that for wave 2 to wave 3 is normally longer than wave 4 to wave 5. So as you can see, we had a very good run since 2012, right? 2013, 2014, 2015, right up to now, okay? We've been record high, and the question is how far can we go, right? It's $1 million question, and we've been tracking this move high in the wave 5. For now, the trend for the S&P is still bullish, right? So I would dive into smaller time frames to show you how far can wave 5 go, but before that, right, let's look at the credit crisis in the 09 lows, and then before the market crash, right? So from here, let me just start from scratch, right, to give you a guideline of how we get alley wave, how we plot alley wave counts, right? So in this case, we are starting from the important low, as I mentioned, okay? So in this case, we'll be starting from the important low. So it's very, we could pick, there are 3 bottoms over here, right? So we can just pick either one. Probably I just pick the center one, right? And then wave 1, wave 2, wave 3, wave 4, and then wave 5, right? Now, of course, you can always resize, you can always move the wave, right? So all you have to do is click on the crosshair and then just move the wave, right? Now, once I've plotted 5 waves, the next question is, let's assume that we are at 2006 or 2007, right? We'd like to know how far can wave 5 go and what is the turning point of wave 5. So let me just show you step by step on how to get the turning point of wave 5. Now again, this is not hindsight trading. We are just using alley wave as a leading indicator to tell us approximate turning point for wave 5. We could be wrong, but if we are right, the risk and reward could be very favorable. So in trading, it's all about risk and reward. It's all about how you stretch the profits and limit your downside risk, right? So in this case, my first objective is to locate the turning point of wave 5, right? So the first thing to do is let's get a set of retracement, right? In this case, we'll be using an extension, right? What we call a FIB trend-based extension. So I'm gonna first click on the low of wave 2, second click wave 3, and then third click at wave 4, right? Now, of course, you know, wave 5 will be normally shorter than wave 2 to 3, right? So since 2001 to, that was the tech bubble in year 2000, right? So it was not a downright, you know, a crash, but, you know, over the course of 2 or 3 years, it's been dropping and then rebounded, dropping, rebounded. Okay, so important low in this case 0, 1, 2, 3, 4, 5, and then the approximate. Okay, the approximate target that I'm watching, let's say for wave 5, right, be 127.2. That's for the first set of FIB extension, right? So let's increase the probability a little bit to give me a context of where is the probable turning point of wave 5. Okay, so I'm going to be drawing a retracement from wave 1 to wave 0. Right, so let's cross check the 127.2% retracement where we first plotted. This will be the first set, and let's take this as the second set of FIB. It is a retracement, but you know, we are using the extended measurement. Okay, so this is the second set of retracement. Right, so you know, the first thing I'll be looking for will be a cluster, right? So let's look for cluster. So you know, we can see the 127 and the 200%, that's one cluster, and 161 and 61.8% is there's another cluster, right? But we just breached the 61.8, so we're gonna scrape this one, right? So the next target that we are watching, so the first target has been breached. Okay, so every time you see, you know, wave 3 high has been broken and we are moving high into wave 5, we are watching the next target, which is the 127.2% retracement. So let's see. All right, so let's fast forward a little bit. Let's move a little bit higher and then starting to hit. Now, of course, you know, FIB extension or retracement, just to give you an approximation, right? Sometimes we do not have to be just following the textbook right exactly at the 200%, right? Even at 100%, that is our first target, right? First target of turning point. So most of the time I'll be locating the first turning point, the first target, right? So in the newsletter or in the video, you'll be seeing a lot of you know, first upside target and second upside target, and that is what we meant about first upside and second upside. So the first upside is 100%, second upside will be 127. All right, for more advanced traders, you could use first and second target to scale in and out of your trades. All right, so we hit the first target. Right now, once the market has hit the first target, the first thing to do is that, you know, we will be watching if the market is responding to the 100% retracement. If not, the market could, right, extend higher. So in this case, it extended higher, very close to the 200. In fact, I think we did hit the 200% retracement. So from wave 4 to wave 5, you know, to give me a better context, what I'll be doing is I'll be drawing an even smaller degree 5 impulsive wave. So in this case, you know, we have another 5 impulsive smaller waves. Let me just change the color so it's clearer. All right, so we hit the 200% retracement, right, completing orange wave 5. So let me just repeat. See, every time we mention in the video update is that when we break down from wave 4 to wave 5, you get smaller 5 waves, right? So if I break down from 2 to 3, I will be getting another smaller 5 waves. So as you can see, another smaller 5 waves over here, right? When I break down from 2 to 3, and another smaller 5 waves over here from 4 to 5. Now the most typical pattern from 1 to 2, it could be a complex like this, ABC, and then followed by another ABC, right? Or just an ABC, right? So, you know, I'm going to show you the latest chart that we were in a complex correction. So, you know, it is very important for a trader like yourself to understand, you know, you need a context of the markets. Else, you know, most of traders will just panic out of the position, right? So we hit wave 5, and let's say we establish a short position. Where should we place the stop loss, or where should the bearish wave count be invalidated, right? The objective is that we reach wave 5 and then we establish a bearish position. So let's assume that we have a short position. Okay, so I'm gonna be placing the stop loss right above of the 61.8% retracement. So that's right around the level of 1664. All right, so you know, my objective is that I want to capitalize an ABC corrective wave. I will not know how far this can go, but again, we're not predicting a crash. We're just expecting an ABC corrective wave, right? Any crashes will be bonus, right? So let me just repeat that. Okay, so let's say we establish a short position, stop loss at about 161.8, right? So the market, you know, form an ABC corrective wave. All right, now here's very important. You see, if the markets break the low of wave 4, okay, it is very likely that, you know, more sellers will be coming into the market, pushing the markets down, right? So in this case, you know, we have broken a very important support level, which is the wave 4 low, right? And then this was another week, so about 3 to 4 weeks, very dark times. 08, that you know, a lot of people are losing their jobs, and then companies like Baston's are going bankrupt, right? When we break wave 4, okay, we should not call this an ABC corrective wave, so it's going to be a new impulsive 5 waves to the downside. Okay, so again, you know, if I break down from 2 to 3, now this is a weekly chart. So if I break down from 2 to 3, this weekly chart, you know, this range could take about 5 to 6 months, right? So weekly chart means that one candlestick, 1 week, right? If I break down from 2 to 3, you can see another impulsive 5 waves to the downside. Okay, so I'm going to change the color over here. Right, so you know, we have a 5-way impulsive wave to the downside. Here's the interesting part. Okay, when this is broken, now in any wave theory, when the wave 4, the previous wave 4 low is broken, okay, a new impulsive trend will be developed, and in this case, you know, the mid or most of hedge funds will be watching, right? If this is broken, now, as I mentioned, from 2 to 3 will be longest. This is where the pure profits will be made. Okay. Now, of course, you can make some profits 4 to 5, but you know, when the previous condition of wave 4 low is broken, this is where, you know, we got a good 1,000 points drop, right? You know, options that are 3 months out or 4 months out. Some of them could be worth about 50 times over. So, you know, but again, the fundamental is that when the wave 4 low is broken, okay, you see the market is starting to trend, right, well into the wave 3 support level. Okay, so the next thing is how do you get the wave 5 turning point? Right, how do I know how far the market will go and rebound? Okay, so I'm gonna just type in turning point wave 5. Right, so in this case I'll be using a retracement because we'll be using the tech bubble high, right, and then drawing way back into 1983. So to get a cluster, I'm going to be plotting from 2 to 3 and then 4. Okay. All right. So in this case, we rebounded from the 50% retracement. So the cluster is that, you know, let's draw the first set from 1987, that the stock crash where, you know, I believe Paul Tudor Jones made his first I believe 300 million or something with this crash, right? In 1987, right up to the tech bubble. No, I'm sorry, right up to the 2007 high. So the first set is at 61.8% retracement, right? So the market hit 61 and then, you know, bridge it and then turn back from the 61.8% retracement. The cluster is at 38.2 and also 61.8. How do we get the cluster? The second set of fib. So second set of fib, we can be drawing from this wave from 2 to 3 and then 3 to 4. All right, so in this case, it's going to be the 38.2% retracement right down to the 50% retracement. All right, so and then where are we now? So went higher into 2011, had a drop in October 2011, 2013, 14, 15, right? And we are right over here, 2400. Okay, so let's move to a smaller time frame for the S&P 500 on the daily chart. Okay, now if you refer to the previous video updates, we talk about the 61.8% retracement. Okay, where I pick up some of the S&P, you know, call option contracts to perhaps swing trade this move from wave 2 to wave 3. Okay, so at the 61.8% retracement, right, that forms wave 2, and right now we're moving high into wave 3. If we break it down from wave 2 to wave 3, another minus impulsive 5 waves to the upside. Okay, so in this case, you know, now expect the S&P to rise right up to the 200. Expect the S&P to rise higher and bridge, you know, it's possible that we just rip higher and break this resistance, right? And for the S&P 500 moving into the false chart, okay, similar pattern. We have this minor degree 1, 2, 3, 4, and 5. Okay, so I would like to know how far can wave 3 go. So the first thing to do is to draw an extension, right? First click, second click, and third click at wave 2. All right, so the upside target for wave 3 will be at a 161.8% retracement at the underlying of 2469, right? But the initial target, right? Initial target is right at the 127.2% retracement, right? That's the target that we are watching. Now, the 100% will be critical. If we break this level, it is very likely that the S&P just moves higher into the 127.2% retracement, and that forms wave 3. Okay, so on the 3 hours chart, right, this will be showing you a much clearer picture from wave 1 to wave 2. The reason why we call this a complex correction, which we had on the last 2 weeks. Okay, it was a complex correction because we had, so complex correction look like this instead of just an ABC, because it's going to be too shallow for us to call this wave C, right? So we expect another drop lower, right, with another ABC corrective wave lower into the fib support of wave 2. So how do you get the support of wave 2? So the first thing to do is draw a retracement. Okay, so the turning point for wave 2 will be 61.8, which we place some. Looking to press this higher well into the 2420 level, right up to the 230 level, which I plotted just now, right up to the 100% retracement. That is the first upside target. Second upside will be 127.2% retracement at 2444 level. All right, so welcome back. The next technique I'm gonna be sharing with you will be 3-step process to enter a trade, because I'm getting a lot of questions from some of you, especially beginners, how to structure a trade, how to track the risk and reward, and how to automate an entry at predetermined critical turning points, right? So I mentioned earlier we use Elliott wave to give us a context when a market is in a bullish trend, consolidating, and we combine this with fib retracements, right, to gauge critical turning points. That is where you should be selecting your strike prices when it comes to trading options using Elliott wave and fib retracements. And most investors think the only way to make money from the markets is to wait for the markets to start trending and miss out on a good trading opportunity. Now, in fact, I always believe the 70-30 rule, which 70% of the time the market is in non-directional consolidating pattern, right? And only 30% of the time the market is in trending mode, right? And how to potentially turn every $1,000 into as much as $5,000, or every $5,000 into 15,000 with defined risk. And what do I mean by that? Now, a lot of time, when it comes to non-directional markets, for those of you who are a little bit more advanced, right, what is an iron condor, right? I'll show you this one strategy that I use a lot, which will be a butterfly spread in technique 3. I'll be showing you very shortly to increase the risk and reward. And the risk and reward for butterfly spread can be potentially higher than an iron condor, right? You can actually get close to 100% to 200%, right? You can get anywhere between 100% to 200% return on investment on your money. All right, so let me just give you an example on how to first establish a trade and then first automating your trade to take profit. How do I automate a take profit based on the underlying? Right, so I'm going to be using an example on GDX. Right, so let's switch over to the case study video lesson right now. Right, so let's move on to Tesla, which is the trade that we have. Right, so we have a butterfly spread on Tesla. Let's run a simulation on the existing spread that just got filled on yesterday. So we got a 305, 340 and 370 put butterfly spread on Tesla. Right, so it means that we need Tesla to chop around the 340 level, right, and the body will start melting away. Right, so that will be the body of the butterfly, right, as long as we can chop within this range. So for Tesla, we're tracking this ABCDE consolidation pattern, right? The longer we chop sideways, right, the body of the butterfly is then melting in, the blue line, that will be beneficial to our existing butterfly spread. Right, so the max profit is about 8,000, and if Tesla all out rallies, that will hurt our butterfly spread, and if Tesla all out crashes, that will also hurt our butterfly spread, right? So in this sideways consolidating markets, we just need the stock to chop sideways, and then we just need a time decay to work in our favor. So gold has been acting very strong, and we're in this ABC corrective wave higher. Nonetheless, we are facing the 161.8% retracement at the underlying of 127.66, right? So it's quite possible that we are facing a wall of resistance right up to the 78.6% retracement. In fact, we should be booking profits, right, on our existing position on GDX, which I'll be covering very shortly. When wave C is complete, expect a decline into wave D and we could be trapped in this larger degree consolidation pattern. So we still have some room to go for GDX, and let's automate a trade to close out this position, and I'll be expecting this profit at 26.48, right? So I'm gonna walk you through step by step on the current position on GDX, right? So let's say for this position 22.5 call, right? I'm gonna close this out, right? I'm gonna set a condition if GDX hits the 26.48 level, right? So I'm gonna right click, create closing order. So this window pull up from the bottom, click on the gear button on the right hand side, right? You see this window popping up. Right, I'm going to change this to GDC, means good deal cancelled. I'm going to click on symbol. Now you gotta be careful with this, at or below, at or above, right? So in this case, this will be at or above, right? At or above, and just type in the target level, which is 26.48, right? So I'm going to just go ahead and type it in, 26.48. Now again, if you click at or below, right, and you send this order, chances are your trade will be taken out when the market is open, right? So we do not want that to happen because we are looking to stretch the profits for this trade, right? So I'm going to click at or above, right? It means that, as if GDX rises to this underlying, right, anytime from now, this position will be taken out, right? So I'm going to click on save, and the final step is just click on confirm and send. And then just send this order, right? You should see this order under working orders, right? So there you have it, working orders 1. Just to cross check GDX, the position waiting condition, it means that just click on this gear button on the right hand side, right? Just to confirm again, the trade says that if GDX goes up at or above 26.48, right, my call position will be taken out of the markets, right? Now, what is the approximate P&L for this particular trade? Because I have several positions on GDX, right? So all you have to do is click on analyze, okay, right? I'm gonna just select the date today, right? September the 6th, right? So just click on risk profile, type in GDX. If you have a position, it should pop up over here. This is a hockey stick looking chart because it's a call position, right? So at 26.48, right, the expected profit is about 6,283. right? So if a GDX rises higher, of course I can close this out with a profit right now, but I do not want to do so. So my objective is that if GDX hits the take profit point of 50% retracement, just to cross check, at the 50% retracement at 26.48, all I have to do is mouse over to 26.48, right? And that is the expected profit. Right, I would say this is a good trade because we are going almost deep into the money, right? So that's how we place a conditional take profit. Okay, welcome back. Market Makers Technique 3. How do you combine Elliott wave and theory? In this technique, I'll be showing you how to automate an entry at predetermined critical turning points. Right, so most investors think the only way to make money from markets to wait for the markets to hit a certain price point and miss out on a good trading opportunity when not in front of the computer, right? So again, I'm not a big fan of staying in front of a computer and watching every tick, and even worse, right? I used to be a day trader, and it's one of the worst things you can do to your trading account, to your portfolio, because it really, when you're making money on good days, right, you'll be overly optimistic and you start to develop overconfidence and you start losing money, right? And by the end of the day, your broker just charge you a big commission, right, by day trading, right? So again, when it comes to trading options, we are trading on a very lean. Trading options is can be quite lean because for most brokers they charge between $1 and $1.50, right? So most of the trades, when we establish one trade, we just leave the trade into expiration, right? Most cases you pay between about $5 to $10 per trade, right? So actually there are two types of two steps to increase your probability of success with these two tools. And what do I mean by that, right? So let me just switch over to the video lesson, the case study video lesson, and show you how to increase the probability of success. All right, welcome back. So technique 4, I'll be showing you how to structure a butterfly spread, how to increase the risk and reward in a consolidating market. All right, so right now if you look at most of the markets, we're in this consolidating pattern, right? Most of the time, if you see even in 2017, right, we spend most of the time in this sideways non-directional market. How can we capitalize? How can we increase the risk and reward, right, in a consolidating market, right? Now, for most stock investors, all right, let's say you're a stock investor, when it comes to consolidating markets, right, most of the time, you cannot do a lot when it comes to markets like this, right? Probably you just keep your stock, right, waiting for the markets to move higher, right? So, when it comes to options, most investors think the only way to make money from consolidating markets would be buying condors, right, or apply directional option strategies, right? Now, I'm going to show you in this video the risk profile or risk and reward for an iron condor versus a butterfly spread. So there are 3 vital components to structuring a potential 3 times return with very small cash outlay. What do I mean by that? Right. So let me just switch over to this case study and show you on this video lesson how we structure a butterfly spread and what is the difference of returns of an iron condor and a butterfly spread, right? Right, moving on to Google. So we have a butterfly spread on Google as well, and the body of the butterfly will be at about 955. So reason why I love to use the risk profile tool is if you have an existing position, right, all you have to do is type in the ticker symbol, and the risk profile will just populate telling you where is the current what is the expected P&L butterfly spread that I currently have. And all you have to do is check the current underlying, which is 944, right, to know the approximate P&L for Google. Right, so 944, the current P&L for the butterfly spread that I have will be at about 3,869, right, and the body of the butterfly will be at 955, right? So if we can drop around this level near to expiration at 950 and 955, we see the profit maxing out as the purple line starts to melt in a blue line, right? So for those of you who are new to the risk profile tool, the blue line will be expiration and the purple line will be the current simulated price, right? So assuming if I simulate this 1 week forward into September the 8th, right, the expiration for this butterfly spread will be September 15, and right now, let's say 1 week from now we can stay in this range of let's say 950 right up to 961. We expect 1 week from now the time decay to work in our favor, right? And the purple line pushing near to the blue line, and let's say 1 week from now we just chop around this level, right, at 955, right? We can just close this up with a profit, right? Or if we just leave into expiration, right, the profit from 943 is 7,700, and 970, that will be about 6,000. So as a trader, the best thing we could do is check the current wave count of the markets. So for Google, we're still in this consolidation pattern, And with the butterfly spread that we have, we are well positioned to capitalize on the time decay as Google chops sideways. And the ideal scenario is that, a few weeks from now, just chop around this level. Google can go a little bit out of the range into wave D and then drop right back into the 955 level and then expire around this range. And we should see an acceleration in the profits for our butterfly spread. So that's how we capitalize on a sideways consolidation market. Right now, typically the risk and reward for butterfly spread is higher than an iron condor. So I get questions from some of the traders, why not we just establish, let's say, an iron condor, right? So if you check the risk and reward in this, the existing spread that we have, so max profit is about 12,000, and the max risk is about 3,007, right? So that's about 1 to 3, 1 to 4 risk and reward. So that's not bad. If you run a risk simulation on, let's say, an iron condor on Google, right? You expect the risk and reward being less than a butterfly spread, right? Of course, you have a wider range. You can always select the upper. You can always select the upper leg, right? Make the iron condor wider, but there's always a trade-off. As you increase the range, you see that your returns for the iron condor will be much less. In some cases, if you put up, let's say, $1,000 as a margin, the returns that you'll be expecting will be about $200 or $300, right? But if Google goes out of the range of the iron condor, you could be losing the entire $1,000 to establish the iron condor. All of your questions over this webinar, right? So the first question, how and when to place a butterfly spread? I answered this earlier in the previous slide. How and where to set a stop loss after trade entry. Now, before I switch over to the case study and video lesson. So for instance, you have entered a vertical spread, right? So there are a few things you have to be careful about setting a stop loss. The first is you do not want to place the stop loss too close to the entry, right? So you might get whipsawed. And for vertical spreads, it's a risk-defined trade. You know what is the maximum risk and what's the maximum reward. So you cannot lose anything more than that, right? So let's say, the maximum risk for vertical spread is $500. You cannot lose any more than that because vertical spreads are essentially a hedge trade, right? And the third question will be Elliott wave drawing. How to combine fib retracement with Elliott? I answered this earlier. Right, you can always go back to this on tomorrow. We'll be sending you the replay link. You can always go back to review the video lesson, right? And the fourth question will be how to identify trade setups, entry, and stop loss. Right? I believe so. This question will be very similar to question number 2. And what is the ideal date to expiry? All right, so it really depends on the wave count. All right, so for instance, if I'm using a daily chart and I'm plotting Elliott waves on a daily chart, I would say the ideal date to expiration will be about 35 days to 40 days. Okay, and if I'm watching a weekly chart, I would choose between 60 days to 90 days expiration. So again, refer back to step 1, which will be the directional assumption, and gauge how long will a wave last. Right? This can be found in your trader's report and also the video update. Right? And the fifth question, 20 years Treasury bonds current direction. Right, so I'm going to switch over to the latest video update and show you what is the current direction of TLT bonds, right, to answer your question, right, and how to increase consistency and building confidence to go live, right? So I would say that after attending this webinar, if you can grasp a few concepts and if you can get about 60% to 70% probability of success, that means out of 10 trades, about 6 to 7 trades go in the money, right? Do not be afraid to trade, to place those orders, right? It can be on a paper money account. Just place the trades and see how those trades pan out in your favor or against you, right? So the most important thing is that you have to place a trade, right? If you're not confident, just trade it on a paper money account, and if you get more confidence, more consistency, let's say about 60-70%, right, and you're more comfortable putting real money behind, behind your trade ideas, right, then go do that, right? You can always switch between paper money and live account. All right, and for those of you who have a live account, you can use this feature called on demand to build your consistency and your confidence. Right, now this is a feature on Thinkorswim. Right, it's a free feature. It's a feature that you can rewind the time, and let's say the best way is to just retrieve the traders report and see what I mean by building your confidence and consistency. Right, so I'm gonna be using the same feature on demand. Just click on demand. You can see you can always switch back and forth the date, right? And then you can use any stocks, especially you can use the stocks that we recommended on the traders report, and see how those trades go in real time. So on demand is a very good tool. Again, it simulates live trading, right? So I'm going to use an example on Freeport, all right, on this technique called tiering entry. Right, tiering entry means that we are scaling in and out using vertical spreads. Right, so first click on the date icon. Now please make sure that on the live account, when you click on demand, all right, so this will be first tier will be 4%, right? That will be $400. Okay, that will be all right. Now this is very common. Most of the time when you establish, let's say, a vertical spread, it goes out of the money. All right, so it goes out of money. This is where we enter tier 2 at 3%, which will be $300. Okay, so fast forward about 1 week. So beauty of on demand is you can fast forward. So fast forward 1 week, April the 13th. Okay, so now both tiers are in the green, right? Tier 1 and tier 2 are in the green. Now for vertical spreads, the return on your money should be about 100% returns. So if you're putting up $300, you expect about $300 to be your profit, right? So let's fast forward about one more week, all right? Now even though the market FCX has retraced a little bit, but still in the green box, right? Assuming we let the both tiers to expire naturally, we gain a max profit for this trade. So in this case, the first tier will be $400 and the second tier will be $300. In total, we gain $700, all right? And the initial capital will be $700. So a broker returned the $700 as margin plus your $700 profit. Right, because both tiers are in the money, in the green. Right, so this will be an advanced guide to trade vertical spreads. Right, so step 1 is to check the trader's watch list. It's typically about 2 to 5 stocks, can be found in your trader's report. Step 2, directional assumption. Right, try to use fib and alley wave that we describe in this webinar for ideal entry timing. Step 3, assess important fib zones, right? To place a conditional stops, you can always use the Thinkorswim trade tag. Okay, so this will be a scenario with the example I gave you earlier, right? So we establish a bullish vertical spread. Scenario is that underlying rises, max profit will be captured if expired worthless. Right, assuming this will be credit spread, but if our underlying drops below strike price, right? Again, check the market sentiment 1 to 5 days before expiration. If this is a credit spread, right, just close it out with a loss because I do not want to get a sign. All right, so let me just give you an example how to read the report. All right, so let's assume we are taking Apple as an example. in this case, right, we are in this ABCD pattern. All right, so how do we capture from wave D to wave E? All right, so by reading the report, it says that you know, Apple is going to drop from wave D to wave E. All right, all right, so in the directional assumption column, you can see that resistance is 61.8. Everything done for you. So we have calculated that 61.8 for you, and we expect a short-term pullback into wave E. All right, so in this case, I'll be using this. In fact, this was a live trade, and I'm going to be showing you the same on-demand features to show you how to capture this trade, right, from wave D to wave E. All right, so let's begin. And so first, after we have plotted the ABCD pattern, right, I'll be drawing fib retracements. This is how we combine elliott wave and fib retracement. All right, so the 61.8 will be acting as the resistance for wave D. All right, so I'm going to change the line to red. Okay. Right, so wave D turning point, and then we expect Apple to drop from wave D to wave E. So to draw a fib retracement, first click will be 100%, second click will be 0%. And on Apple, right, let's assume that this will be a bearish vertical spread. All right, so that's how we place a bearish vertical spread at 111 and 112. All right, so tier 1 entry will be 4%. How do I get the 4%? All right, so 4% will be displayed under your max loss. When you click confirm and send, it shows you that your broker will be taking up 580 to establish this put debit spread. Right, this will be expiring in 31 days. So I'm gonna just check the wave D, and this will be a green box. So as long as we can stay below the red line, all right, fast forward 3 days, as long as we can stay below the red line, this trade will be profitable. Right, now after 3 days, this is quite common, right, when it comes to vertical spread. All right, the underlying moves against us. Right, this is where we enter tier 2, right, to average in the trade. All right, so tier 2, I will establish a new spread. Right click, it's going to be a put debit spread. All right, so because the underlying is different right now, and tier 2, right, max loss is 450. It should be about 3% from your entire portfolio, right? So when we place this order, all right now we have tier 1 and tier 2. Okay, so I'm gonna fast forward 1 week into April the 19th. All right, now both tiers are in the money right now because Apple dropped from wave D to wave E. Okay, so as long as we're in the green box, these 2 tiers will be profitable. All right, so if the trade can expire in this green box, okay, we gain a maximum profit from this vertical spread. So again, I mentioned about the tiering entry. This will be tiering exits. So that means that we are taking 50% of the position off to book half of the profits, to take some money off the table, right? So how do we close half of the position that we have? So let's assume we have 20 lots when we first enter this trade. So right now I'm going to close out 10 lots, right? And remaining will be 10 lots, right? So we have book profits, half of the profits. And of course, if you let both tiers expire in a green box, you gain a maximum profit, right? So in this example, I'll be showing you how to close out half of the position, right? This is what we call tiering exits. Okay, so now how do we get the downside target? All right, so first click will be from C wave, and then second click will be D wave. In between, we get 38.2% retracement, 50%, and 61.8% retracement. All right, the downside target, the first tier will be at 50%. All right, in rate. Okay, fast forward another 1 week, April the 27th. All right, so there's an earnings, so I see a crash in Apple. So Apple hit 78.6% retracement. In this case, both of the tiers should be showing maximum profit because we closed out half of the profits earlier, right? So we are only left with tier 2, which should be 10 lots. All right, so that will be an example on Apple. Let me show you another example for Freeport. Okay, so how do you read the trader's report? All right, April the 11th, 2016, directional assumption, wait for support, bullish trade setup. It says that step 1, directional assumption, will be bullish for FCX or Freeport McMoran. All right, so bottom line is the objective of this trade will be capturing wave 4 to wave 5. Right, and you know, if you see the description, directional assumption, wait for support, trade setup. Right, so I'm going to show you the technicalities of setting up this trade on FCX, an example. So let's dive in. Right, so for FCX, we plotted 1, 2, 3, 4, 5. Right, the objective is that we capitalize from wave 4 to wave 5. Right, so the first step is to get the turning point of wave 4. Right, so in this case, I'll be drawing a fib retracement, 100% to 0%. First click will be wave 2, second click wave 3, and we get the turning point of 38.2% retracement. Right, in this case, the 38.2% retracement will be, I'll be changing the color to red so it's more visible. We just rebounded from the 38.2% retracement. Right. So how do we set up this trade? How do we set up this bullish vertical spread to capitalize from wave 4 to wave 5? Although we did not enter the trade when the market hits 38.2 for FCX, right? Is it still possible to enter this trade? So the answer is yes, because you know, wave 4 to wave 5, there's still some room to go. I'm going to show you how to place this trade. Right, because the nature of trading vertical spreads will be a little bit different compared to, let's say, trading futures or trading stocks, right? So in this example, I'll be showing you a call debit spread. All right, so we enter trade 2 tiers as well, 10 lots first tier, 10 lots second tier, right? So about 2 weeks later, fast forward 2 weeks with the on-demand feature, all right, Freeport rebounded from wave 4, and now both tiers are in the green, all right? So, you know, when the box are in the green, right, the next step is to check the upside target, all right? Where should we book profits, or should we let this expire worthless, right? Or should we let this expire naturally, right? So the 78.6% retracement will be first upside target, right? And we are almost touching the 78.6% retracement, right? So for FCX, so that would be a first upside target. Fast forward another 1 week. Okay, so we had a pullback, but we're still in the green box. So most of the time, if we check the markets like this, you know, as long as we're in the green box, I'll just let the trade expire naturally, all right, to gain a maximum profit from the spread. Okay, so we got another move higher in the wave. If you break down from 4 to 5, you'll see another impulsive 5 waves to the upside. Right, that's how we get a context on the market. So most of people, they act emotionally when it comes to trading spreads like this. Right, if there's a pullback, tend to cut losses and then they miss out on another move higher. Right, so you know, on your trader's report, if there's a bracket trade update, that means that we are updating the last trade that we put out. Right. Okay, so let's move on to technique 5, how to increase the risk and reward per trade. How to use tiering entry and exits to increase the probability of success, which I showed you earlier on free pot. And most traders think the only way to make money is to trade vertical spreads with one tier. Actually, there are two vital components to using tiering techniques. This tiering technique with 100 to 150% returns on your money. What do I mean by that? Right, so tiering entry and exits, it depends on your risk profile. Right, if you're an aggressive trader, tier 1, you risk about 8% per trade. Tier 2 will be 7%, 6%, and 5%. If you're moderate, not so aggressive trader, I would say, tier 1 will be 5%, tier 2 will be 4%, tier 3 will be 3%, and tier 4 will be 2%. And if you're a very conservative trader, tier 1 will be 2%, tier 2 will be 1.5%, tier 3 will be 1%, and tier 4 will be 0.5%. Right, so I believe you have access to this file. What you can do is to key in the variables into this Excel file, refer to tier position Excel file, key in your latest account value, and you should be getting what is the maximum risk for the first tier and second tier. Right, now with that, you can always check the max risk when you place a trade, which I showed you earlier, which will be the max loss, all right, for the trade. That will be a margin required by your broker, right? So that's for FCX. Let's move on to EWJ, which will be Nikkei, TF4 Nikkei, all right? So for bearish trade setup, let's say from wave 3 to wave 4, all right, we have a rebound. So I'm going to run a trade example on EWJ. Right, so let's assume tier 1 be 4%. Click send, and let's assume that we have this trade for tier 1. All right, so this is very normal. All right, within the first few days, all right, your vertical spreads might be going in and out of the money. All right, so let's assume that we're entering with tier 2, okay, with 3%. When our first tier is challenged, we will be entering at with 3% tier 2. All right, so for tier 2, it'll be 11.5 and 12, 3%. Right, I'm going to change the color to red. So if EWJ rises above the red line, then the vertical spread will be making a loss, right? So, that red line will be acting as a conditional stop for tier 1 and tier 2, right? So again, I mentioned about placing stop losses. You do not want to place stop losses when, let's say, about 1 to 2 weeks in, because you do not want to get whipsawed, right? I like to place conditional stop, let's say 3 weeks in, and if we are deep in the money, the conditional stop will be minimizing the risk, or making the trade break even. We have no risk left for this trade, right? So let's fast forward 1 day. Okay, 2 days in, now we are in the money for both tiers. Right, so on your positions, on your activity and position statement, it will show you not the max profit, but just maybe a partial profits for both tiers. All right, so fast forward 1 day. Okay, still in the green box. Fast forward 1 day. Alright, so now it's working out fine for us. Still in the green box. Okay, so probably now is the time to maybe place a conditional stop, right, at the top of wave 4, so that we have almost no risk left for this trade. But if we can, stay in this green box, you'll probably capture max profit from this trade. Okay, so to close this order, this will be a step to close an order. Right click for both legs, create closing order, and there you have it. All right, so we have closed this order out. All right, so So I mentioned about moving the conditional stop to break even. In this case, you have no risk left for both tiers. All right, so this was what happened to the trade example on EWJ. We established a bearish vertical spread and scenarios underlying drops. All right, time one expiration, max profit expired. If this is a credit spread, max profit will be captured if it expired worthless. Right, if underlying rises, check market sentiment. Right, are we, maybe chopping this resistance level? Okay, 1 to 5 days before expiration. If you are being challenged, just close it out. All right, or for debit spread, you can just let it expire naturally. So the question is, how do you capitalize on high probability trade patterns? Step 1 is to identify wave patterns. Step 2, identify wave turning points. And step 3 is to establish the right strike prices. All right, so when it comes to vertical spreads, you can select any strike prices. It really depends a lot on the current underlying price, right? So timing is everything when it comes to trading vertical spreads, right? So, for instance, in this case, emerging market CTF, 1, 2, 3, 4, 5, an impulsive wave, identify the wave pattern. Right? In this case, it will be a pullback in the wave 2, and then the next step is to draw fib retracement from 0 to 1 to establish the turning point for wave 2, and then use that as a gauge for your vertical spread, right? So this is an example of Netflix. Initial capital outlay about 5,000, return on investment about 3,500, right? If you let it expire worthless and it's a credit spread, you expect 100% from your $5,000 initial capital, all right? Right. This is how we capitalize a wave from wave 2 to wave 3, right? This will be green box, right? Green Mountain Coffee, GMCR, bearish vertical spread, and this will be green box. Okay, so I'm getting a few more questions. Why trade SPX instead of SPY? Now, why do we trade RUT instead of IWM? So bottom line is, for instance, 10 contracts are SPY, right? You pay 10 lots commission to broker, that would be $15, right? If you were to trade just one lot of SPX, which will have almost the same leverage of 10 lots of SPY, you'll only be paying $150, right? For one contract. So it will be much more cost efficient to trade SPX. Now this will be on a larger account. If you have small accounts, I would say so if you have a larger account and if you trade a vertical spread, now even if you trade a vertical spread on SPX, the margin required can be as low as $400, $500. Now for SPY, it can be $40, $50. That means you only need $40 to establish a vertical spread. So if you were to combine market makers technique 1, technique 2, technique 3, and technique 4, right, do you think you can be successful in trading options, right, or even trading stocks, right? So I believe that good traders have special talent for trading just as good musicians or athletes. Talent in trading can be developed, all right? And I believe that great traders listen to rhythm of the markets, all right? The market moves, like I mentioned in this throughout this webinar, right? It moves in this wave pattern, this wave principle. All right, so we are coming to an end, and again, this is Terrence, and I hope you enjoyed this webinar. If you have any questions, always feel free to drop me an email, and if you have any questions regarding plotting any waves, if you have any questions on the trade execution, or if you have any questions regarding the subscription, feel free to drop me an email. I'll be more than happy to help you out. And me and my team would like to thank all of you for joining this webinar. And I hope you have a great weekend and a great trading week ahead. Right? So again, thank you so much for joining this webinar. I certainly have a great time, even though it took me a long time to prepare for all those, to prepare this webinar and with all those materials and with all those care we put in to help you to trade better. Okay, so have a good evening, and I'll see you.